Good afternoon, ladies and gentlemen, and welcome to the GRESHAM Technologies PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, all questions will be reviewed with responses published on the Investor Meet Company platform where it is appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will notify you by email once these are ready for your review. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Ian Minocha and CFO Tom Mullen. Good afternoon.
Great. Well, many thanks for the introduction. Lovely to be here again. Doesn't seem that long since we were here sharing the full year results from 21. And we've got another good set of results that I'd like to spend a little bit of time talking you through. Tom's going to cover the financials, and we'll spend a little bit of time also talking about our strategy and a little bit on what the second half of the year looks like as well. Sorry, just bear with me. So for those of you that are new to the story, here's really GRESHAM at a glance. And indeed, GRESHAM is now very much the Clarity business. And so let me just talk you through what that is all about. So essentially what we provide is software as a service solutions for control and automation in financial services. Financial services is our primary market. And as we'll talk about, we're starting to expand into other adjacent markets as well. Our purpose is to enable financial institutions to digitize their operations, and that gives them complete confidence in their data and their processing in order to improve their competitive position and, of course, manage risk, drive out cost, and also protect their reputation. Now, everything that we do is built with Clarity. Clarity is our own IP, our own technology platform, and it's an enterprise-grade software as a service platform. And in very simple terms, it enables firms to connect, reconcile, and control any and all types of data and process. Okay, so we've been running at this for 10 years, as I'll come back to in a second. And so now we've got 270 customers around the world in 30 different countries. And we're focused on an immediate and compelling opportunity, which is to win about 500 banks and 1,000 buy-side firms that we think are relevant for what we do. And that's our core market. It's a $500 million growing market. And our aspiration there is to take 25% of that market share. And the reason we've got confidence in our ability to do that, got a proven team, proven strategy, proven organic growth, and also growth through acquisition, and a very strong culture of looking after our customers and growing those relationships. And that's got us to a 26.1 million recurring revenue business today. And our ambition would take us to being around 100 million pound recurring revenue software business. So that's us at a glance as we are today. So just quickly a summary of the first half. Really pleased with some of the new wins that have come through. 6 new name wins in the first half, and a 7th one actually signed in the first week of July. Those wins are in our core markets, new banking clients, new investment management clients, and they're in our core geographies. Wins in North America, in the UK, and in continental Europe. We've also made good progress with our installed base, and very good progress in particular with key accounts. And I'll touch on both of those points in a second as well. We're also 1 year on from Electra. That deal completed in almost exactly 12 months ago. And, that is really starting to drive some new opportunities. So we'll spend a bit of time talking about that. So all of that, I think, is adding up to a very slightly improved organic growth story. And of course, that growth is all about driving subscription revenue. And we'll wrap up a little later on, but I can confirm that we're seeing really good demand at the moment. There's very good momentum in the business. We've got a good pipeline, and we're on track to comfortably meet our market expectations. So I think it's a really interesting time to take a step back actually now. This month coincidentally is exactly 10 years from when we went live with our very first customer, with the very first early adopter release of our technology, our matching engine that now is the heart of the Clarity platform. And that kind of version 1.0 went out, and the rest of the business really has come from that moment in time. And if you think about what's been achieved over the last 10 years to get us to that point of 26 million of recurring revenue and 270 customers, we've had a very clear and focused plan over that period in terms of investment and growth. And you can see from that chart on the right hand side, that's really our ARR over that 10-year period. In orange, and then in blue really is that Clarity cash EBITDA. And you can see that in the last period, the last 6 months, we've passed a really important milestone for the business, which is that early years of investment into product, those early years of investment into building out our infrastructure to sell and market and implement and support customers globally, has passed that really important inflection point. So Clarity is now an attractive, cash profitable, standalone business in its own right. And you'll see that quote from Mark Andreessen there. Mark Andreessen is a very well-known tech founder from the early days of Netscape and Mosaic, and a very well-respected tech investor. And his quote there, "No one should expect that building a high-growth software-powered company in an established industry to be easy. It's brutally difficult." And for that, we're very appreciative of your support as investors over that period. And of course, the team, the Gresham team that's worked so hard to get us to this really important milestone. So now we'll talk a little bit about that industry that we're focused on at financial services, because that's our compelling opportunity in the near term. And perhaps one thing that has not changed over that period, but the implications of that failure to change have become even more significant. Firms are held back by their legacy processes and legacy operations. Any large global institution that you go into today is plagued with data quality problems that cause breakage. Those errors compromise their business. It forces them to carry risk. It ensures that they have potential for poor reporting to the regulator. It costs their reputation. It costs them customer service, and they carry ultimately cost, and that's holding back their innovation. And of course, around those firms, the industry is being reimagined through digital transformation, new uses of data that can drive insight. The reconstruction of the financial services industry that we all know as consumers is going on at a pace. And so for the financial services industry as a whole, and in particular the firms that we're targeting, they desperately need smarter automation and better control over their data and processes. And so you can see on the two ring charts there, our core immediate term opportunity is that $500 million market in capital markets, heavily weighted towards North America, but actually outside of capital markets onto the banking side of the book, retail banking, commercial banking, the payments industry, for example. There's a broader spread of opportunity for us as well. So that's the market that we're going after. Very strong, structural tailwinds for us in that space. We've done an amazing job of winning new names over the last 10 years. We don't often show this slide, but if you take a look at that, I mean, there's just some incredible high quality customer names in that mix, whether they're on the banking side at the top, in investment management, or down the bottom in corporates, in industries, such as insurance, or energy trading, or indeed, wins in government, when we've won our first customer in government, which just shows the potential for what we do to spread out cross industry over the longer run. So it's a remarkable list of achievements that we're building on every day. And the reason that we're being successful is that we're strongly differentiated in terms of our technology offering into the market. And this slide really just sums up our Clarity platform is eating into that landscape of competitors, the landscape of competitors that are, installed and endemic across the financial services industry, spreadsheets and manual processes, or hard-coded in-house developed systems, or in some cases, legacy vendor products. And those that have the largest market share were built and engineered in the late 80s and early 90s, on an architecture that does not give, our prospects and customers the flexibility they need for the future. And there's also newer entrants, generic data engineering tools, or other point solutions. And really, what we're doing is we're breaking into that market with Clarity, which is now proven across a wide variety of use cases. It's truly enterprise grade, and as a platform, it can cover the broad variety of use cases that any of our customers see. And we're doing it with modern technology that's flexible, it's easier to use, it's very intelligent technology, and it's functionally very rich. And that means faster time to value and a lower cost of ownership for our customers. So, pretty much every single deal that we get into, and the 6 new name wins in the first half are all examples of this. We get into competitive tenders, full requests for proposals, more often than not, proofs of concept. And at the technical level, consistently, time and time again, we prove to customers that we can handle all of their data types, we can process faster, we get better match rates that drives out financial return, more productive UIs, and all of that contributes towards a business case, which I'll say a few words on in a second. But at the technology level, we're a noticeably better proposition for our customers, and that differentiation is now well proven and increasingly accepted in the market. Today, we don't propose to spend too much time talking about the technology and the roadmap. We spent a little bit of time on that at our full year results only a matter of months ago, and we will be having a capital markets day, and we'll share the outcome of that for all of our investors. So really today I'll just summarize and remind everyone of some of the core things that are in the platform and why it's so powerful. In essence, the platform can take in any type of data, whether it's coming in batch or real time, whether it's standardized data or unstructured, unformatted data, can profile and validate that data, look for problems. We can apply business rules over that data to control it. And the matching engine can match in any numbers of sides of data in order to look for inconsistencies across those different files of data. We can apply automation techniques to intelligently process the data. And then the output of that, where errors, inconsistencies, exceptions are identified, can go into a fully functional workflow environment. Exceptions can be resolved, and customers can report on that and get insights into their data in a way that enables them to consistently improve the quality. So that's in a nutshell what the technology does. And the use cases for that technology are very broad and varied across the financial services sector. And in many of our customers, they'll have dozens and dozens of different use cases for the technology, which is how we can grow with our customers. All of that drives a very strong business case for our customers. And that business case is based upon what I call the 3 R's: risk, resilience, regulatory, and reputation. But it also has a concrete impact on customers, gives our firms assurance around the accuracy and completeness of customer journeys. For example, thinking about payments, did the right money get to the right party at the right time? As well as, of course, driving out cost and improving efficiency. And increasingly important, of course, is the experience of employees within the bank or the financial institution, who are, and that employee experience, in a remote working environment, in an environment where it's hard to find talent and hold on to people, it's hard to fill roles. Having better technology support for employees is incredibly important nowadays. And all, of course, leads to strategic value for our customers. Ultimately, we make them more agile. We give them greater confidence in their processing, and all of that plays to their future competitiveness. And there's a really, really great quote there just from one of our tier 1 customers, really around what we're doing, and the quote there: ditching legacy solutions that were holding them back from achieving their business and customer growth goals. So it's a super story, great technology, delivers value for customers. And, as we build the business, all of that serves to drive a financial return for us and for you as our shareholders. So at that point, I'll pass to Tom to talk about the financial model.
Yeah, thanks, Ian. So firstly, the first thing to say on this is our financial model with Clarity really hasn't changed for some time. We're building a high growth, high margin, sticky recurring revenue business. And this slide remains very similar to the equivalent shown at the time of the full year results. So in the top chart there, you can see Clarity revenues growing 71% of our group revenues. Those Clarity revenues driving a gross margin of 85%. That gross margin is a percentage point higher than it was for the full year last year. Last year was 84%, so a slight improvement there. We're building Clarity ARR. On a 5-year organic CAGR, we've grown that at a rate of 22%, or when including the M&A activity over the last 5 years, and that goes up to 37%. That Clarity ARR is very sticky, as mentioned, with a net retention rate over the trailing 12 months of 105%. Now, we were reporting 106% 6 months ago, but in actual fact, if you were to strip out the impact of 2 Russian-owned customers that we cancelled the relationship with, we'd actually be back at 106%. Now, that high margin, high growth Clarity business, as we said 3 months ago, you can really see in the group results now that that's dropping through to the bottom line at a group level. The group cash EBITDA is improving in absolute and in margin terms. So up to 8% for the first half of 2022. That is driving the obvious improvements in free cash flow. So now just to move on and have a look at half one in particular. And we won't spend too long on this slide. This is just some of the financial highlights, or in fact, the key financial highlights, both at a group level across those top three charts there, and at a Clarity standalone level in the bottom 3 charts, which again really just shows the continued trend of all of our key metrics heading in the right direction. And we expect that to continue to happen 6 month on 6 month, year on year as we continue. One thing should call out, we have been helped by currency tailwinds over the last 6 to 12 months. And the numbers presented on this slide and largely throughout the half year report are on an actual currency basis, but are called out where there are significant differences, or equally called out if there aren't significant differences if it was to be on a constant currency basis. So just to call out a couple here, group revenue, if it had been on a constant currency basis, 23 million shown here would have been 22.5 million, so $500,000 differential. But actually at a group adjusted EBITDA and cash adjusted EBITDA level, the difference is far lower, less than 100,000, in fact 100,000 rounded, and that being reflective of the fact that that we have a lot of natural hedging going on. We have a significant cost base in US dollar and Australian dollar that creates for a natural hedging instrument throughout the business. So Clarity forward-looking ARR in particular. So very pleased to say that in absolute terms, the first half of 2022 was our best 6-month period ever, increasing ARR by 2.1 million. And in fact, the last 12 months where we have increased ARR organically by 4 million is our best individual 12-month period. Now, admittedly, that is helped a little bit by those FX tailwinds. But it's really strong and fantastic performance by the team all the same. Can see some of those growth rates that we've already mentioned, or both on a 5-year CAGR basis, or at the year-on-year increase of around 18%. Of that 26.1 million forward-looking ARR, important to remember how that's then recognised over the next 12-month period, and can say that we're expecting, or not expecting, we will be recognising 13.2 million of that 26.1 in the second half of 2022. So it's slightly weighted towards the second half of the year. Now, if we move on to have a look at how that has actually flown through historically into the P&L or the income statement. Here we can see the graph or the table or chart on the right left-hand side even. The orange bars there are our Clarity recurring revenue in 6 monthly bars. You can see growth there from the previous half to 12.5 million. You'll remember that on the previous slide I talked about us having 13.2 million of revenue already contracted to be recognized in the second half. So we are already have under contract recurring revenues that will be showing growth in the second half against the first half. So it gives us great confidence as we enter the second half, and equally great confidence beyond. The navy blue bars at the bottom are representing our Clarity services and contracting revenue. You will see a larger increase from 3 to 3.9 million from the first half last year. But of course, in the first half last year, we didn't have the Electra business. We hadn't made that transformative acquisition. So that's driving the bulk of the difference between the first half last year and the first half this year, with a smaller jump between the second half last year to the first half this year. On the right-hand side, we break down the forward-looking Clarity ARR by in a number of different manners, by region, by currency, by industry segment, product, and deployment. And I'll just call out a couple of those. I won't walk through them in full. So region and currency, as you'd expect, are largely similar. North America being largely equivalent to the ARR that we collect in USD. Not 100% the same for a variety of contracting reasons, but loosely similar. So that gives you a good breakdown and an expectation of what currency we are bringing our revenues and cash into the business in. The other one I'll just call out is industry segment. So industry segment, Ian has talked about the traditional capital market space, the 500 million, $500 million market that we were originally going after with the original target market for Clarity. Approximately 3/4 of that pie representing an industry segment is in relation to that capital markets area of the business, with about 1/4 coming from the other side of financial services, the retail banking, the commercial banking, the insurance broking, etc. So we do have meaningful ARR already coming from outside of that capital market sphere.
Yeah, thanks, Tom. So yeah, just to take a step back up and look across the installed base. So, I mean, it's a phenomenal installed base, both in terms of the quality of the logos, but also the number of customers, 270 customers. And, you know, the way that we structure our license agreements, you know, ensures that we get the opportunity to cross-sell and upsell within that install base. So in terms of account growth opportunities, you can see on the left-hand side there, you know, product cross-sell. And of that chart that I showed you earlier on of customer names under control or customer names under connect, there are a number of customers that have multiple products. So that's always positive. We can see growth in new use cases, and we license the software based on the number of use cases, which in our language is the number of controls. So very often a customer will sign up for an initial entry point of 5, 10, 20, 50 controls. They'll implement, they'll go on, and then they'll consume more. And so if you look at the first half of this year, alongside those 6 new wins, there were more than 20 contract uplifts, you know, within the install base. So that's very, very encouraging. And our organization is set up and geared to support customers, ensure that they're successful. And we've put in place some new functions over the last 6 months, really to drive the management of the portfolio of customers in the regions on a more strategic basis as well. In terms of our new sales efforts, we're systematically targeting the larger global banks and investment managers. And, you know, if you look across the entire install base, we've now got 18 accounts with greater than £250,000 worth of ARR. So that's annual license fees coming in from those customers. And in those larger accounts, the net retention rate is higher than the average, which is really encouraging. So, you know, we're at 121% on a constant currency basis in terms of those, you know, the larger end of all of our install base. And then within that larger end, there are some customers that we've designated as key accounts. And those are customers that we believe we can lift to being greater than $500,000 of recurring license fee within a 3-year period. And those customers do tend to be the bigger ones. They tend to influence our product strategy. They tend to influence the market generally. They're great reference names. And, you know, we've got particular focus on winning those clients, as well as, of course, then growing them. So here's just 2 of those key accounts. They became GRESHAM customers in 2018. They followed a slightly different trajectory, but over a 4 to 5 year period, you know, we've 10x to their initial investment. And with both of those customers, further growth is possible over the medium and longer term as well. So, you know, in these large global banks, we don't see that we will top out in terms of the business we can be doing with them, even with our current product offerings. So the one on the left is a global retail and commercial bank. You know, their first relationship with GRESHAM was a Connect agreement in July of 2018. You know, a year on, we got our first control project with them, actually into a subsidiary company that they were building as a neo digital bank. That went really well. That turned their attention to us in terms of what we could do within their core banking business. And we signed a contract with them for their UK retail and commercial bank that gave us that substantial uplift in 2020. And then a couple of years of working, making sure that we were implementing, getting them happy and successful with that, gave them confidence to make the decision to say, hey, we are going to go across the entirety of our UK business with GRESHAM, with the control product, and further raise the ARR by another $500,000 and we made that announcement a month or so ago. And within that contract, there's further growth expected in the near term, in line with delivery milestones. So that's just one example. The customer on the right took a slightly different trajectory. I won't go through all the bullet points, but the point remains, that what we go after is these, potentially lower value entry points, but we can rapidly do a great job, get the customer happy, prove the value, not just of the technology, but of the relationship, and go on and grow those customers over time. So taking a step back now and looking at Electra, really important deal for us a year ago. You can see on the right-hand side a quick summary of that transaction. We won't go through that now, but that deal closed almost exactly a year ago. So 1 year on, we're actually delighted with how this has played out. First of all, the retention of the installed base of customers has been excellent. In and around the kinds of net ARR retention rates that we were experiencing in GRESHAM pre the acquisition. At the time of the acquisition, we shared with you 3-year historical financials, and you'll have seen that their organic growth rate had been single digits up to around 10%. We've actually lifted that slightly now and would expect to continue to do so. And over that first year, they've had new client wins in the US, in Canada, and actually first deals into Europe as well. The hard yards of integration are now largely complete. Teams have been cross-trained, single organization is in place, products rebranded, and actually by virtue of bringing the teams together and doing that cross-sell, the cross-training rather, the cross-selling is now coming through, and we've got some really good combined opportunities now, combined product opportunities, because the team is already one, where we're selling, for example, the data business with the control business. And that's a real differentiator in the market actually for us. It really, really differentiates our control offering versus the generation of competition that I was talking about earlier on. Single global organizations working well. We're really pleased with the team, how we're working together as a single global team. And really now it's about capitalizing on that. The product development plans are well aligned, and the sales teams are out, working together in the market. So all hugely positive. And as you can see there on the right-hand side, in terms of the transaction summary, we're generally, delivering where we expected to in terms of the forecast. And I think that's probably a good segue over to you, Tom, to comment further.
Yeah, absolutely. So we'll actually move on to talk about the Electra deal more in the context of cash and the deferred consideration. So starting with the GRESHAM cash position, the end of the first half, we were at 6.5 million. That's entirely as expected. As a reminder to everyone, free cash flow will steadily improve on a year-on-year basis as we drive that cash EBITDA upwards, albeit it is significantly second half weighted. Actually, it's significantly Q4 weighted, more specifically. On an annual basis, free cash flow is increasingly becoming similar to cash EBITDA as working capital cycles normalize, and there's no debt in the group at this stage. Looking forward, our annual cash inflow will remain heavily weighted towards Q4, and that's just reflective of the fact that so many of our subscription agreements are paid annually in advance and mapped to the calendar year cycle. So December, we have significant cash collections. We'd expect continued growth in free cash flow. And again, just as a reminder, we do have a $15 million revolving credit facility available that we put in place at the time of the Electra acquisition, should it be needed to cover our low point at the annual cash cycle, which coincides with the Electra first deferred consideration payment. Now, to move on and talk about those deferred consideration payments a little bit, The excellent financial performance, as Ian has just described, means the first payment will be made in full. So that's $4.8 million, currently £4 million worth. That'll be paid over the next month to 6 weeks or so. And the second deferred consideration payment, which will be 12 months after that, all the signs at the moment point towards that being in full or at least towards that level, which again is reflective of the really strong retention metrics that deferred consideration was linked to in the first place, being at the level that, or in fact above the level we even hoped.
Great, thank you, Tom. So I guess just taking a step back up now and looking ahead, just want to say a few words on group strategy. Whilst the strategy to focus on building the Clarity business and recurring revenues hasn't changed, as the business has matured and got scale, the opportunity has become larger for us. So in terms of our growth strategy, the dimensions of that strategy include progressively moving cross-industry. So we started in capital markets. We're now working in financial services more broadly, and that includes areas such as payments. We've talked about the land and expand strategy. You've seen over the last 10 years the international growth strategy. We started off as a UK business with a centre largely around systems integration work in Australia. We've now opened up very strongly into the US, particularly bolstered by the Electra acquisition. We've opened up offices in Europe, and we now have customers in 30 countries around the world. And then there's the cross-sell strategy, and the example there that I talked about in terms of, selling data and control together, and of course the M&A piece. And if you look around this wheel of organic growth, going deeper with our blue chip base, really sweating the Electra opportunity, continuing to really drive the banking business. And we genuinely believe there's an opportunity to double the number of clients in the banking market over the next 3-year period, targeting those new use cases and then progressively moving out into newer verticals. And the ones that we already have customers established in, and they're really beachhead customers, they're reference customers in insurance, in energy, and in public sector. We'll continue to invest in product, but as I said, we'll spend more time on talking about those product plans at the Capital Markets Day in the autumn. And then alongside that, when appropriate for the right, carefully targeted acquisition, we have an opportunity to take a step change and accelerate growth and earnings. And our thinking around this, is never to do anything that's going to upset a really good organic growth story. But we will continue to look for the right opportunities, adjacent areas in terms of what we do in post-trade, as well as going deeper into the data and the connectivity challenges that our customers face. So if we put all of that together, and this is perhaps the most important slide, what can that do for the value that we're creating in the business?
Yeah, so Clarity as a standalone business has just gone through the cash EBITDA break-even point for the first time, so it's generating cash on a standalone basis. So we're really taking that from as a starting point, and this model hasn't really changed, but it is the first time we're presenting it externally. So if we continue to drive organic ARR growth at 20% or above, we'd expect, or our sort of plan going forward, is to look for that each pound of ARR growth to drive cash EBITDA margins of around 40%. Now that model assumes a continued balanced approach towards investing for growth versus driving earnings. So it would be around an 85% gross margin, 40% cash EBITDA margin after investment for that continued growth. And of that investment, the vast majority of it would be going towards distribution, so sales and marketing, as opposed to significantly on the product or the back office side, where any further investment will be at a far lower rate than it is on the sales and marketing side. So under this model, we see progressive annual improvement in cash EBITDA as the business continues to adopt best practices and grow at scale. What this model does not include at all is the Clarity Services business or the other non-Clarity businesses. Now, as a reminder, the Clarity Services business is purely in place to ensure our customers are successful in implementing and then operating Clarity. And of course, any ongoing M&A has the potential to uplift the revenue growth rate, the earnings rate, or both. So Clarity as a standalone business is now very attractive, cash profitable business. And that's a very different place from where we were even 3 years ago.
Yeah, it's a hugely different place. And I hope as you can see how if we extrapolate that model out, the value that we're creating for you as shareholders. Now, of course, building a great company is not just about the financials. And I'll just wrap up, by just giving a little bit of an update on some of the things that we've been doing over the last 6 months. So clearly, we're building a company with a great culture. We consistently score well in our annual engagement surveys around things like teamwork, and of course, being focused on customers. We've spent a lot of work in recent years around our values, about creating together, i.e. collaboration, about embracing difference, and championing success. And I think our focus is now increasingly around the topic of ESG, one that's very much on all of your agendas as well. And so we've been doing things like putting ESG champions in place across the business, and you will see increasing focus around disclosures, for example, on carbon footprint. All of that, is, I think, really important for us to be doing. We're acutely conscious that the success of the company has come from the talent we have in the business. We continue to ensure that we look after our people, and that has been a real challenge, I think, in the current environment of where there's a war for tech talent, and inflationary pressures. But I think we've taken a very, thoughtful and considered approach to how we've, approached annual pay reviews as well. And as an employer, we give our people, very flexible hybrid working environments. We support them with a program of wellbeing initiatives, and mental health as being one example. We're investing into leadership development programs. We've been running that again in the first half of the year. And actually, we've run a graduate program this year, and we've got a fantastic team of young people coming through that program this year as well. So we're focused on building not just a very valuable company, but a truly great company. So just to wrap up and summarize then on the first half, and to look at what we have to do, in fact, for the second half of the year. More of the same, but we are now very focused on ensuring that we build ARR into 23 as well. And that means cross-sell and upsell, as we've been talking about, but also, winning and growing our key accounts in the second half, investing, as Tom was saying, to scale up sales and marketing to build pipeline for next year, ensuring that we deliver the upside, both in terms of the synergies and the growth from Electra, and then continuing that innovation story. And for those of you that have followed us, we will also be launching the digital banking offering that we have made several announcements on over the last 3 years, that is the output of our venture with ANZ. So a few things to look forward to in the second half, but in terms of outlook, great demand in the market for what we do. The tailwinds are there in the market. We've got very good momentum. Our pipeline is, at this point in the year, arguably the strongest we've seen. As we've been describing, really excellent visibility of the full year revenues, which gives us, complete confidence in comfortably meeting the full year forecast. So at that point, I'll take a breather and pass back for any questions from the audience.
Ian, Tom, that's great, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Ian, Tom, as you can see, we've had a question come through from investors throughout this presentation, and thank you to all the investors for submitting their questions. If I could please hand back to you to just run through that Q&A tab, and where appropriate to do so, if you could please just read out the question and give your response, and then I'll pick up from you at the end. Thank you.
Yeah, thank you. So we've had one question very early on, actually, in the presentation, largely around growing the customer base and the land and expand opportunity. So I hope that we've already covered that particular question. And then one that's just come through, what's the catalyst on the pipeline? How does the sales process drive that? It's an interesting question, and I guess the core of that is, how do we get engaged, in opportunities? So, clearly we're doing a fair amount of direct sales and marketing into a market that we've segmented. So we know the 500 banks and the 1,000 investment managers that, on paper should be a good fit for what we do. And so we target our digital marketing, we target our outbound reach with our, telesales and telemarketing teams. And, we constantly look for opportunities to open up those relationships. And we typically target, as our initial point, the operations functions of those institutions. Although, once engaged there, we will then also broaden out our activities to engage the IT function and lines of business function. And the sales process then will aim to do a number of things. First of all, open the customer's mind to the art of the possible, because what we're doing here is we're bringing a disruptive technology to them. And the fact that there is a technology that can handle all of their data types and provide control across the breadth of controls they need in their business, that is not something that they expect to find in the market. A market that's riddled with point solutions or in-house builds. So there's a process of engaging the customer to really show them what the art of the possible is. And that's if we get in early. Sometimes we're coming in when a customer's already been doing some thinking work. They'll always go through an RFP process. There'll always be competitors. And therefore, it's quite typical for us to do a proof of concept. And I would say 90% of our pre-sales work involves a proof of concept. And we'll drive that sales process. And a key part of our sales process will also be about bringing the customer together, helping their operations folks work with their IT folks to build the business case, and helping them identify the opportunity to save money, the opportunity to drive customer revenues, the opportunity to improve their management of risk. So our sales process will involve us supporting the customer in identifying the value. So I hope that gives you a little bit of a flavor of what a sales cycle looks like. There's a couple more questions that have come in. One of them is, a few years ago, a major deal was won by a systems integrator. There appeared to be optimism for working with these organizations, but no more similar deals since. What has happened? I wouldn't say no more similar deals since. Actually, a number of our deals, we do work with systems integrators, and indeed, since working on that original large contract, and it's a shame that we can't name names, but since working with that original large contract with a global systems integrator, we've built partnerships with a couple of other large global systems integrators. And actually in the last year, we've also built partnerships with at least 2 of the core banking platform vendors, both of whom recommend us as their partner of choice. So our work in partnering has continued, but we haven't announced specific deals that have been sold in partnership with systems integrators, but it remains a key part of what we do. Just working through a few more questions. Tom, was the one you were
do
going
you want me
to
to so there's one here. Can you comment on new customer average contract value and its trajectory? And obviously there's really two angles to this. So firstly, I think if you were to ask me 3 years ago what our sort of usual contract term was, I'd have been saying 3 years. Now I'm actually saying 5. Customers are looking to commit for a reasonable period, and then they all normally auto annual renew after that. In terms of then the annual value within that, it's certainly increasing across the board, both on the existing Clarity side and the Electra side. What you will see if you look at customer numbers that we've announced over the years, though, is that you may see some odd relationships in that, because the Electra average deal size is typically smaller by the nature of the companies that it serves, in that it's more buy side specific, where the opportunity on an individual basis is slightly small, but the volume's much bigger. So there is a slight nuance there, but on the whole, average contract values are increasing.
A few more questions. One very specific: are proofs of concept projects chargeable? And the answer to that is, in general, no, because the technology is actually very flexible and fast to implement. And in general, our teams will be able to stand up proofs of concept very quickly. And it's in our advantage to show the customer that that's the case. And so proofs of concept we do very well on. The customer sees the rapid return on investment, they love it, and so in general we've taken the approach that is part of our commitment to the relationship. There will be times when a customer wants to extend a proof of concept and do more with us and go more hands-on, and in some of those circumstances we will then charge them a nominal fee. But in general, proofs of concept are valuable for us as much as they are for the customer. Final question there, really around the ANZ venture. How significant is the ANZ venture in terms of orders per annum and average revenue per order? Well, we actually haven't disclosed too much yet on the ANZ financials. If you look at an early announcement that we made, you will see that we indicated that as ANZ roll out the technology, that of the initial scope of the contract, we could see that scaling up to approximately 4 million Aussie dollars within ANZ on its own. So that, I think, will give you a sense of what we think we can do with the current scope of the product in the global market on a per customer basis. So definitely, upside, and that's upside to our current Clarity numbers. Final question. Question around the share price, actually. And the question really is around what can we do to expand the awareness to shareholders of the opportunity. And this is, of course, something that we do spend time on, is promoting the company. We want to get the balance of the time we spend facing off to customers versus facing off to the market. And it's obviously a difficult market at the moment, but I definitely would concur with the sentiment in the question that perhaps the value of what we're doing is not being fully recognized. And so we are and have been over recent months spending more time on non-deal roadshows, some time in the US, some time here in Europe, promoting the amazing business that we've been building. And I think, the fact that the Clarity business now has got scale, the fact that it's now standalone cash profitable, and the fact that we can now comfortably, project out the longer term business model, which is the slide that Tom took you through, I think is, a real inflection point for the company, and, an opportunity, I think, for shareholders to really, understand what this opportunity looks like over the longer run. So I think that's probably it in terms of the questions that are there on that have come in.
Ian, Tom, that's perfect. And thank you very much indeed for taking the time to address all of those questions that came in from investors this afternoon. And of course, if there are any further questions submitted today, we'll make these available to you immediately after the presentation has ended for you to review. And ladies and gentlemen, we'll publish all those responses where it's appropriate to do so on the Investor Meet Company platform. Ian, perhaps for redirecting those on the call to provide you with their feedback, which I know is particularly important to yourselves and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, and thank you to you and the team at Investor Meets Company for hosting us as ever. So yeah, just 10 years on, 10 takeaways to think about. Differentiated software, it's our own IP, it's mission critical, it's proven at massive scale. We've got incredible references. That revenue is sticky, it's recurring, it's growing in a growing market. And we've built out a global operating platform. We've moved into Europe, we've acquired and built out in the US, and we've proven we can grow organically and do a good job of acquisitions as well. We continue to be an innovative company. We're investing in innovation. And as you can see, we've built out a predictable, profitable financial model for the company that will take us forward. And, it's a great team that have got us this far. It's a proven team, it's a proven management team. We're as ambitious and excited about the business as ever, and we have a clear plan to grow the company and deliver increasing value to you as our shareholders over time. And thank you again for your loyalty to us and the commitment to the business.
That's great. Ian, Tom, thank you very much indeed for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of GRESHAM Technologies PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.